What's up, guys? Today's lesson, I have a few PowerPoints I want to go through. So recap and rules regarding strategies 3. This didactic will cover the overall strategy, execution, and identification, trend requirements for execution, 40 executions over a 2-week period, and their risk to reward, respectively. Part A1 is the identification of trend and identifications of potential strategy 3 situations. Part A2 is identification of strike areas, FVG, and O order blocks. A3, target requirements and their respective win rates, which is incredibly important. Stop placement and adjustment, including smoothed win rates, respectively, in trade management. Part B is the backtest criteria. B1, stop placement and risk to reward and win rate, entries and probability adjustment, secondary and tertiary identification of strategy 3, smooth P&L and realistic P&L, spread, late entries, brokerage, variabilities. Part C, indicators and recommendations. The only indicator I use that helps me identify traps, which is pretty much the entire strategy. It's unfortunately taking advantage of retail traders. C2, retail shortcomings and why your mindset has been led to trade retail setups. The psychology traps we all face, taking mental profits and moving stops, and what really works, which is a huge question for people. When to take profits, what is the appropriate risk to reward, and where your stops should be. Improper stop placement and unrealistic thought processes, and expectations versus reality, and how to remain profitable. So let's start with A, identification of the trend and identifications of potential strategy 3 situations. So identification of the trend will go into GBP USD, and I will show you the trades that I took and how to identify them. So first I want to look for variabilities. So I will use this one because it's a clear setup. So we have an obvious downtrend that has already occurred, and we have long trap bounces. Okay, people are trying to catch the bottom and getting stopped out, waiting for the trend to reverse. So we have an order block, which is a massive whip in price. We have a fair value gap, which is actually not in this price. Not all of them have it. And then there is the strike area, where there are 2 to 3 consecutively lower strike areas. So my entry levels are going to be a break, a liquidity pull of at least this strike point. And when I am back testing, I'm looking for how high the liquidity pulled. Did it pull through the fair value gap, or did it respect it? Did it break the strike area, or did it respect it? Did it break the order block and then correct? And I put this all into my back testing. And if you wanted to continue looking for other areas to do this, we have another entry here. And this would be a fair value gap. And again, we have a strike area. So I would look for a liquidity pull of this, and I would look for a rejection if I was going to put my stop behind a pivot, which I will get into the risk reward and the win rate of having your stop above the order block versus having it above the pivot. So if we were playing the pivot here for a break of the lows, it would look like this, okay? And I, of course, am going to go for the higher probability areas. Here we had an aggressive sell-off, and we had 3 strikes on the 1 minute. So on an entry into this area, I have my alert set, and as it pushed up and rejected, I had my stop above the order block, looking for a break of structure here and a break of these lows. However, when price moved in my direction, I moved my stop down. Okay, so identification of trend and identifications of potential strategy 3 situations was the order block, fair value gap, and 2 to 3 attempts to break it consecutively lower. The identification of strike, FVG, and order block has been covered. And target requirements. Target requirements are quite simple. I look on usually the 5-minute, and this is a great example. So we have obvious liquidity, but liquidity has already been pulled. Liquidity, liquidity, liquidity. It was pulled, and a higher attempt was made. So this could be the final target, or a break of the lows here, which we have done. So we have 1 attempt and a pivot, a 2nd attempt and a pivot. So on a short of this area, you are looking for a pull on the first liquidity zone as TP1 and a pull on the second as TP2. However, I have noticed that TP2, the second liquidity zone, tends to have resistance in the area like so, which it did here. So what I would prefer to do, and what I would recommend is, instead of taking profits on your first liquidity zone, which is here, I would say take profits as it moves into the order block of the second liquidity zone, because this tends to be a higher reversal point. And if we are going to continue into an uptrend, this is the area. So I will take profits here, and I'll move my stop to break even. And as it breaks through, I take profits again. My stop is already at break even, and I go for the long target. And we would have gotten it. All right, these are the trades that I took yesterday, and I will recap them. Stop placement and adjustment, including smooth win rates. I'm going to show you odd USD, the trade that I took yesterday. Okay, so here we have a massive whipsaw, and we have a strike area, right? 1, 2, 3. So ideally, I want to see price move into this area and reject it. If I wait for a close and an entry like I did here, there is a high probability that I will get stopped out. So this is where the stop above pivot versus stop above order block situation comes into play, and I want to go over the back testing and probability, win rate, and success rates. Okay, so in a situation like this, I will put my stop at a clean 1-to-1, and if price does in fact continue, I will use my market intuition and my experience to decide whether or not I should cut the trade or I should add to the trade. Now, in all of my back tests, I have written down that I'm looking for an E bar or E bars, which is exhaustion bars, effectively long traps. What retail traders tend to do is they enter and pile into positions and build up liquidity chasing breakouts. So as an aggressive high is broken, or I'm sorry, a high is broken aggressively, that's actually when I'm looking to sell. I will actually just sell the tops of exhaustion bars, and I will average into the trade so I don't go full margin immediately. So in a situation like this, we have a very exhaustive situation and a final push up. I sold here on the break with my stop above here. Now, if I go back and I look at my risk to reward, my smooth P&L, if I do this exclusively, I will still have a smooth profit. Okay, so my profit over time will still be up. This can be your entire strategy right here. However, as price goes in my direction and gets close to my area where I want to take profits, I can adjust my stop up and let the trade play out for me, which increases my win rate. So the average win rate in retrospect, in hindsight, is between a 5 and 6R, depending on where you put your stop. In situations where you put your stop above the order block and you potentially average into a trade, the smoothed risk to reward is between a 2.5 and 3.5, but it is still very profitable, and I'll go over the profitability factors in a second. So stop placement and adjustment, including smooth win rates. And trade management. Again, in a trade where I see that the price is moving in my direction, there is no longer a reason for me to risk anything that I'm not comfortable risking. And if I am going to move my stop to break even, I am always required to take profits, which goes into section C of the lesson. Trade management. As price moves in my direction, I'm going to take profits at my profit taking areas and then move my stop either up to the top of the pivot or to break even. So in the back testing criteria, I was looking for did price break lows? So was it a great win? Was there a liquidity pull, and where did it go? What was the overall risk to reward on the trade? Was it a win-loss, and where was my stop placement? In the first collection of 20 tests, my stop was consistently above the order block, and out of 20 trades, I had a 68% win rate, My average risk to reward was a 3.57, and most losses occurred when the trades were held past the first primary liquidity point and trend continued higher after pulling the liquidity area. So the price did not go in my direction. Instead, it went to the first liquidity zone and actually continued higher through my stop. So those were the majority of my losses. There were 0 liquidity pulls before sell-off. Okay, so that means that instead of going into the order block and pulling above any of the strike areas or pulling into the fair value gap, it didn't go high enough, and I entered presumptively at too low of a price. And instead of getting a good short position, it just continued higher. So in retrospect, the losses were taken primarily when I did not wait for a rejection of key areas. And of course, some of the trades just did not work out. Notes, some highs when pulled still respected the fair value gap and then continued below. So when stops were adjusted, I still would potentially get stopped out, but it still would respect the fair value gap. So in retrospect, if I had kept my stop above the fair value gap, perhaps my win rate would have been better. However, I believe that my average return or my RR would have decreased in that situation. In the next group of 20 trades, out of 20 trades, my average RR was a 5.49%, so almost 2 R more. My win rate, however, decreased by 15%, so I took more losses. However, this study, most stops were above the pivot. Okay, so I had a pivot entry and a pivot stop. I didn't put my stop above the order block. Instead, as the price started to move down, I entered and I kept my stop above. Overall, a higher RR was created, 3.57 to 5.49, but the win rate was decreased by 15%. Okay, so I believe if you were to calculate all this data over an infinity time frame, your RR and your win rate would be smoothed out regardless. So it doesn't matter as much where you put your stop, it just matters more about when you enter the trade. Are you waiting for liquidity to be pulled, and is your stop in a reasonable area? All losses were AP placements, which means above pivot placements. 0 losses were AOB placements, which is above order block placements. 3 out of 8 losses did offer a first target liquidity pull of approximately 0.3 to 0.5% of the underlying price. So that means if I was shorting Euro USD, I was able to take 0.3% to 0.5%. So the price of Euro USD went down 0.5%. 2 to 3 trades were bullish entries. And it should be noted that strike identification was much harder to establish, meaning there were not clear rejections and attempts. And the breakout strength was spread across many more bars compared to bearish strategy 3 situations. So this strategy seems to be much more easy to identify on the short side. And then I want to get into the secondary and tertiary identification of strategy 3. The secondary and tertiary identification of strategy 3 is actually when I see a lot of bullish failures moving into the price. Let's see if I can find a great example. Here is a great example. When you get a very, very convincing break to the upside, only for it to pull lows. So we're moving away from this order block. We get a very aggressive bull entry, and even though we do get about a 1-to-1 on it, it still fails. And then we get another really great pivot. People probably bought here and were stopped out. Here we get another great pivot. It wasn't even worth a 1-to-1 before selling off and stopping people off. Here we get another great pivot and actually finally held. But after 4 or 5 attempts at the upside, it finally held. And then aggressively pushed, showing retail traders most likely that there was bullish strength. They were looking for a continuation and a change of market structure, just to hold the level and sell off. So those are my secondary and my tertiary identification. My tertiary, or my third way I identify this trend, is I want to see that it has pulled into a gold zone area, like so. So this is an indicator I use. This is the only indicator I use besides footprints and level 2 is volume position and negative levels by chart prime. The gold levels is high buy interest. However, when you look at footprint and level 2, high buy interest areas are usually active buyers and their orders are getting filled by passive sellers. So there are sell limit orders here. Active buyers and retail buyers are buying into this level only for their orders to get eaten up by sell side liquidity, and it ends up holding. So in a situation like this, I visually see that it was a clean rejection of this area and it was unable to break the highs here. So I can take a trade going for, again, a 1-to-1. I'll say, okay, I don't know if it's going to hold this level, but it may hold this level. Is this a 1-to-1? Yes. So I can then look at something like this and go, okay, I really don't like the way this is forming. Instead of taking a full 1-to-1 loss, I'm just going to close the trade here. And in retrospect, when I looked at a smooth P&L, if I'm continually making 300 to 500 points on these trades and my win rate is between 50 and 60%, then if I occasionally take 300 to 400 point losses, I will still be profitable because the majority of my losses, I have the opportunity to move my stop to a reasonable pivot area, right? So my smooth win rate is between a 5 and 6, maybe even 7R, whereas I very occasionally take larger losses doing this. However, I'm usually given the opportunity to close the position out for break even or a medium-sized loss. Case in point, this did respect the level, but it made an aggressive attempt, and you can see here the second attempt failed. So this is a great indication for me that we're actually turning back to the downside, and I can sell. And if my initial entry was here, I can close out both for a mid-profit, or I can target that TP2 that I was initially at. And as this first trade comes back into break even, I like to get out of those for break even, because if it just pulls against me again, I don't want to sit through that drawdown. So I may average down into a position to make sure that I can get out of this break even and potentially catch the trend from a better entry. Indicators and recommendations. Again, I do recommend using footprint and getting adjusted to level 2 reading, but the indicator I use is, and I'll show you again, the volume positive and negative levels by chart prime. Second, retail shortcomings and why your mindset has been led to trade retail setups. I traded all the retail setups that everybody else did, and for instance, flag patterns are my favorite things to short because they fail. Breakouts fail 50% of the time. And the majority of times you see a breakout occurring, you're only noticing it because you've seen aggressive buying. So everyone is piling liquidity into those areas. And I understand that in the event that it starts to break those areas, it'll fall through all the liquidity before bouncing. And I'm sure we could find an example on anything right here. For instance, if we go to here we have a big giant bull bar, and we have a second attempt and a third attempt, and it actually holds this level before continuing higher. But in the event that we pull that, what happens? Again, isn't it interesting how as soon as we pull the lows of this, we find ground and continue higher? So if the trend is going to continue, I first want to see other people getting screwed over. And unfortunately, that's just how the game is played. In order for market movers to move the market, they have to accumulate positions, and they can only do that by creating liquidity. And liquidity is created when people get stopped out of trades. So when enough blood has been spilled, the market will in fact go in the direction you were anticipating. So do not fall for the average retail traps. Okay. The reason that I have continually made money with the setup is not because I'm waiting for confluences. I'm generally selling on strength into critical areas because there is such a high probability that is going to reject those areas. And if it does in fact continue higher, I will have an opportunity to get out for break even. But the people who have piled into those positions will already be in massive drawdown. C3, the psychology traps we all face, and taking mental profits and moving stops, and what really works, improper stop placement, and unrealistic thought processes. And this is really important because as a new trader, everybody's looking for the perfect RR. Where should I put my stop? When do I take profits? And the realistic thing is, if you cannot be profitable with a 1-to-1 risk to reward ratio or a 2-to-1 risk to reward ratio, then you are not going to be profitable with a 5-to-1. And the main thing is, the main reason is if you are continually taking losses and then you move your stop to break even and then you're in a great trade and then it goes against you and stops you out for break even, eventually your mental capital is going to be depleted and you are going to make mistakes. So the realistic thing here is to understand that the 20-80 rule, where 20% of your trades are going to make you 80% of your money. And if you are not taking profits at a 2-1 and moving your stop to break even, in the event you go through drawdown and repetitive losses and then just move your stop to break even without taking profits, it's emotionally going to drain you. And that's why I mention taking mental profits. You want to take financial profits from the market primarily for your mental health. All right. Otherwise, you're just going to get beaten down and beaten down and beaten down. If you can remain profitable with a 2-to-1, then you can continue making adjustments to your strategies and start to improve on those strategies and potentially improve your risk to reward to a 3-to-1, let's say. C4, improper stop placement and unrealistic thought processes. A lot of people are baited by the money. However, improper stop placement means you are using very tight stops. If you do not over leverage and you have a larger stop, like I'm showing you with this strategy where I will usually just put a stop in on a 1-to-1 and let it work itself out. I'm not trying to be right at the exact moment, but I am interpreting the market. As a trader, you're not supposed to predict, you're supposed to interpret. So interpret the structure that is being shown to you and formulate your stop around that. Have a wide enough stop where you're able to stay in the trade and identify and interpret when it is going in your favor or when it is going against you, and then either cut the trade, minimize your loss by cutting the trade in half, or add to the position as it does start to move in your favor, understanding what your threshold for risk is, right? I will not risk X percent or more. And then finally, expectations versus reality and how to remain profitable. And again, I just want to beat a dead horse here, but the expectations of the reality is that if I risk $1,000 to make $5,000, I'll realistically be profitable. And what ends up happening is you will continue taking losses. You have a very low win rate. And there will be a lot of trades where in retrospect, you see that you should have taken profits at a certain level and didn't, and ended up walking home with nothing. So finally, to wrap everything up, I want to take you through the 3 trades I took yesterday. So here we have a strike area, 1, fail, bounce, fail, bounce, fail, bounce. And what I like to see is a correction under a trend, correction back into it, and then the move starts to go back into that area, and I will set an alert above the first strike area. On this 1 minute bar, I did in fact take a sell, and my stop was at a 1-to-1, which is well above the order block. As price started to model in this area and started to sell off, I had alerts set here for my first TP, and my second TP was here. I got both of them, and obviously as it moved down close to here, I moved my stop up to above the pivot. So my smooth win rate is my smooth RR here is a 6.21. And it did in fact take out the lows, so I got a full win on this, which is a 6.21 R. Euro USD, I took 2 losses, and I had the opportunity to take profits on one of the positions. Okay. This was my first entry, and this was my TP1. And I had a 1-to-1. No, this isn't what happened. I deleted it. On the 5 minute. I believe that I took profits on this break here. And that's what happened. I had took profits on this break here, and my stop was above this area. Well above the order block, well above the buy side trap. As it broke these lows, I took some profits, and my target was TP2. A retest of this, and then finally a close on the lows. However, it held this level and pushed up, and I was stopped out for a small loss because I had adjusted my stop to here. And then I saw that it had pulled up here and failed. And this was my full loss, and I do not remember where my entry actually was. I actually think that my entry was somewhere in here, and my stop was here, and my targets were the same. I was looking for a pull on TP1, a pull on TP2, and a close on the lows. And it turned around and stopped me out for a full loss, and that's fine. I didn't really love where Euro USD was. I was actually more enticed by this area. And let me cover this real quick. Okay. So you can see we have a big whip area, and we have 1, 2 tests. It came up, test, 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 came up, tested it one more time, and immediately dumped. And that is an actual trade I took, and that is why I am a little presumptive, because sometimes it just taps it one more time and floods, and I'd rather get a better risk to reward. I really understand that this is a profitable system, and I don't need to be 100% right 100% of the time. I do not need to have a 2-to-1 or a 3-to-1 or a 4-to-1 or a 5-to-1 to be profitable. I will interpret the signals and move my stop up accordingly. As this dumped, I just immediately got to move my stop to break even, right? Or I can just keep it above this area. I've already taken profits, I'm already in a great trade. And there you go, right? Broke lows, no problem. GBP JPY was a great win for me yesterday. I took 2 trades on this, and I think I deleted one. No, this is the trade I took. I added, no, I didn't add. I took 2 entries. So my size was much bigger than I should have taken on GBP JPY. I forgot that GBP JPY and Euro JPY have a lot more marginal requirements. So I took 2 positions on this. I closed one at TP1 because I didn't like the size I was at. I wanted to get rid of some. I closed some here, and then I had my second target here, and my third target a pull of this liquidity. Target got taken out here, and I took profits here, and I was pretty much just solid for the day. I didn't move my stop to break even either. I just kept it. I was willing to get back into the trade. However, I think that I saw it doing this, and I was like, nah, I don't want to sell here and then risk all that. So I'm just going to hold on to my final positions. And then as it came down and broke these lows here, I took the whole position off, right? Because I thought, look, we're holding here, here, here. We made a good attempt from here. Liquidity has already been pulled. It may respect this liquidity area, right? This is what this white line is, liquidity. So as it tapped this and pushed up, I closed my entire position, and that was actually quite a big win. However, it did in fact come down and take out the lows, and we can see if potentially we are creating another liquidity area that we could short, and we kind of are. Realistically, I like this a little bit more. I think I would still be willing to short this area if it pulled up into it. But we have repetitive strikes of this area here and down to here. So if we move into this area, I would be willing to set an alert on a break of that high and look for a short. Again, 1, 2, 3, 4 failed attempts, and this one isn't even that good either. I do not love this, but oh well. And Euro USD coming up. Do we have anything? Again, this is actually quite solid. So we have a really big rotation here that was failed. It pulled down 1, 2, 3 strikes. Right? It came back up, lower, 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 and then we actually had a sell-off. So here we have a strike area and we have an order block area. So we've actually already tapped into it, but I think I would prefer to wait for a pull on liquidity on London session, because currently we are getting closer to the end of Tokyo session. So if price does this and I see an aggressive exhaustive candle or a few exhaustive candles, I would be looking to short this. I would initially have a very wide stop to see how it played out, and I would look to take out the lows, and then I would look for primary liquidity, which just so happens to be TP2 area. Right, we've got a lot of volume in this area, so maybe take profits just before this and then a full pull on the lows. And if price does in fact start to confirm and move like this, I will simply move my stop up here. And now my adjusted risk to reward is a 6.61. In the event that it actually breaks this high and interacts with this, as it starts to come down, I will most likely say, okay, well, now my stop is going to be right here. And if it breaks back up again, I'm out for a loss. As it starts to move into that area, if it makes another attempt and then starts to fail, that second leg failure is something I like to short, and that is part of my strategy number one. So if I see an attempt just like this, another attempt, and it starts to fail, I will short that and put my stop above that second failure high, and I will get right back into the trade, and I will cut this one for a loss. I'm sorry, for break even. As it comes into this, I will cut this for a break even loss, and I will take this for the full trade. I'll just treat it like a brand new trade. Okay, guys, long-winded explanation. Please leave any comments or suggestions, questions, and I'll answer them if I can. Thank you so much for tuning in. Please like and subscribe, and I'll see you guys next time.